I published a new post on May 15th, 2026, discussing some of my recent trades. A link to my blog post can be found in my profile section here at YouTube. The higher inflation numbers are starting to result in higher intermediate and long-term interest rates. The 10-year Treasury closed last Friday at a 4.59%, up from 3.97% on the day prior to the Iran war starting. The Treasury yields can be found at the Treasury website. Just Google Treasury yield curve. The increase in Treasury yields will flow through into other interest rates paid by consumers, including the 15 and 30-year mortgage rates. I'm seeing increasing yields on short-term corporate bonds maturing in 2028 and 2029 that I have been buying recently. I have mentioned here and in my post yesterday the investment rate of new 6 and 1-year Treasury bills sold at auction have risen above the current federal funds range of 3.5 to 3.75%, indicating a consensus type opinion that the Fed will not cut that rate again within the next 12 months. The CME FedWatch tool, which is another thing that I consult regularly, uses the federal funds futures contracts to assign probabilities to changes in the federal funds rate. And it currently has more than a 50% probability, barely over 50%, of a 25% hike in the federal funds rate on or before the December 2026 meeting. The probability of a 50 basis point hike is starting to rise as well, and is currently, as of last Friday, at 10.5% probability on or before the December 2026 meeting. And at more than a 30% probability on or before the March 2027 meeting, that's a 30% probability of at least a 50 basis point hike in the federal funds rate. All of these changes are massive compared to where they were 6 months ago. Rate cuts are assigned a near zero probability in the federal funds futures contracts as measured by the CME FedWatch tool. I benefit from rising rates. It means more income for me. The duration of my bond ladder is less than 2.5 years, and most of my assets are in Treasury bills, corporate bonds, municipal bonds, and CDs. The weighting is substantial in Treasury bills maturing between Monday of next week or Tuesday of next week through the next year. The next 1 year from today, I should say. I have Treasury bills and investment-grade corporate bonds maturing every week. As rates move higher, my interest income rises and is rising now with short-term corporate bond purchases that I've been making over the past week or so. The 5-year break-even inflation rate, and this is a term you need to know, closed at 2.7% last Friday. That is the annual average CPI, consumer price inflation rate, over the next 5 years for the buyer of the 5-year Treasury inflation protected note, the TIP, to break even with the higher nominal yield rate of the 5-year non-inflation protected Treasury. The break-even inflation rate is viewed by many as the market's prediction of the average annual CPI rate over the term of the TIP. And for the 5-year TIP, that average annual CPI rate is now at 2.7%. The 5-year break-even inflation rate closed at 2.26% on 12 31.25. So the increase in the average annual inflation prediction has gone up by 0.44%. And that's an annual number over the next 5 years, and I expect that to continue to rise because the inflation numbers are likely, in my opinion, to continue to go up. I discussed in my last post buying 25 Treasury bills, which included a one-year Treasury bill at a 3.805% investment rate. When held to maturity in 2027, the interest will be taxable to me in 2027. And I'm already starting to shift tax recognition of some income into the following year based on my revised calculation on my likely marginal tax rate in 2026. Realized gains from selling stocks and stock funds is already high this year and near my annual goal. Interest income is starting to rise again. And I will have some special items this year, including the auction sales of several vintage baseball cards, which I've discussed in my blog. The one that brought the most was a 1954 Hank Aaron rookie card. And closing out my HSA account, which is health savings account, which has been out of sight, out of mind for years. I haven't used it at all, and it was the administrator was charging me an annual fee for a monthly fee for administering the fund, which I was not using. So I basically decided to close it out and receive what's left in there. And my understanding of the tax rule is I don't pay a penalty on that redemption proceeds, given my age, but I do have to treat the proceeds as income and pay the income tax on it, similar to what would happen if I was withdrawing money from a regular IRA account. For stocks, I have been a net seller every week this year, except for 3, where I was a small net buyer. For the most part, I am selling my highest cost shares, which reduces my average cost per share, produces less taxable capital gains, and increases my dividend yields. And I've been reducing some mutual fund positions as well and eliminating many duplicate common stock positions where I own a stock in more than one of my 4 brokerage accounts. And I've also been reducing my positions in Canadian reset equity preferred stocks. My investment style is contrarian value with an emphasis on a starting dividend yield at over 4%. But those are hard to find now that where I'm comfortable in actually starting a position. So I'm willing to buy some in the 3 to 4% dividend yield range, like adding to Medtronic, symbol MDT, discussed in my last post. I do not discuss all of my trades. It would just take too much time. For the trades discussed so far this year in my blog post, I have reduced my stock and stock positions by $33,614.28. Profit snapshots of those trades are also in the blog post. I noticed that Michael Burry bought a boatload of Pfizer call options. That's not the way I would play Pfizer, but he's a very good and well-known investor. I hate Pfizer as a stock and discussed the reasons again in my last post. I added just 5 shares to lower my average cost slightly. I refer to that stock as a bond substitute that defines the objective rather than the safety of the dividend. The goal is to realize a total return of at least 2% over the dividend yield. I've been successful with Pfizer, even though I hate the stock for achieving that kind of goal for many years now. I'm just slightly in the hole in one account, and I've got have an unrealized gain in another taxable account. But in other words, I haven't met the goal as a bond substitute yet for that Pfizer, those two Pfizer positions.